Good evening and welcome to the Money Show, your trusted destination for investor education, financial awareness and smarter money decisions. I'm Kavita Thapliyal, and today's fast-changing world, managing money is no longer optional, it is essential. From rising expenses and changing lifestyles to market volatility and digital investing, every individual today faces one important question. How do I make my money work smarter for my future? And that is exactly what this show is here to help you understand. And just in case you have just tuned in, all you have to do is get connected with us for your portfolio queries. So we'll be flashing our WhatsApp number on the screen, the email ID. You just have to note it down, 865-797-4571. That's the WhatsApp number. The Money Show at etnow.tv, the email ID where you can send us your portfolio queries. The reason why I say this is because this is the only show where we answer all your portfolio related queries, help you achieve all your financial goals and the dreams that you have set for yourself and for your family. But then today, something very important that we are discussing on the show. As we reach the midpoint of the financial year, it is a very important opportunity or an opportune time to pause and reflect on the journey so far. The past 6 months have been shaped by evolving market dynamics, changing economic conditions, and emerging opportunities across asset classes. Now, through this review, we will take a comprehensive look at how our portfolio has performed against its objectives, evaluate key investment decisions, and assess the effectiveness of our overall strategy. Today's discussion will focus not only on the numbers but also on the insights behind them, understanding what drove performance, identifying areas that require attention, and recognizing opportunities that can help strengthen our position in the months ahead. We will review portfolio allocation, risk and return metrics, market developments, and the key factors influencing our financial outcomes. This review is an important milestone in ensuring that our investment approach remains aligned with our long-term goals. By examining both achievements and challenges, we can make informed decisions and position the portfolio to navigate future uncertainties while continuing to create sustainable value. With that, let us begin our half-yearly review and take a closer look at the performances and progress of our financial portfolio over the first half of the year. We are joined by Manish Jyoti, Managing Partner, IIFL Capital. Manish, hi, good evening and welcome to the show. Thank you so much for joining in for this very important discussion. That time of the year where we finally look at our portfolio and diagnose it. We post-mortem our portfolio. We try and do what's best, or maybe reshuffle or reallocate our assets and our investments in our assets. But just before connecting with Manish, let's just look at the 5-term process that we usually do when we are reshuffling our portfolio, realigning our portfolio. We have to look at our asset classes. We have to look at the investment so far. We have to look at what is aligned with our financial goals, because when you are making a financial portfolio, it has to be for a financial goal or a financial dream. It could be a short-term, long-term, or a medium-term goal. We are also joined by Manish. Manish, hi, can you hear me? Okay, there I can see you. You are connected. Hi, good evening.
I can.
Welcome to the show, Manish. Thank you so much for joining in today. So I was just talking about the importance of doing this review. Why should we be reviewing our portfolio? Because we have our portfolio designed as per our financial goals, which could be like more than 5 years, 7 years plus, or maybe 10 years away.
So, Kavita, a very good evening to you and the viewers, and thanks for having me on the show. I think it's a very pertinent question given the fact where we've been over the past 12 months with increasing number of variables impacting the portfolio. So I would look at it this way. We get a medical checkup done every year. We take the report to our doctor to identify which all parameters are not in alignment. We arrive at a corrective course of action and implement it over a period of time. Similarly, we create a portfolio, as you rightfully mentioned, for a period of 5 years, 7 years, and in some cases 10 and 15 years also. A lot happens from the time we start designing a portfolio to the time we actually start achieving some or all of those goals. some of the factors that actually impact us could be personal in nature. It could be our risk appetite changes, our goals change, our personal situation changes. To give you an example, what's happening in the IT space in South, risk appetites of individuals would have completely gone out of whack. Then there are market factors which also have an impact, so which we've seen over the past 2 years. There could be tax factors, regulatory factors, which of course can completely throw your portfolio construction out of the process. I think one more reason why we should look at a portfolio review is the emergence of new asset classes, right? So, 15 years ago, crypto wasn't there. I'm not suggesting that we should make an allocation, but at least it is something worth considering. REITs and
Okay.
InvITs have been introduced in India over the past 6, 7 years. SM REITs have been introduced recently. International portfolio diversification has recently gained attention, especially after value erosion of INR. So a lot of these
Right.
factors are incorporated in a review.
But
And
all
I
this,
think
Manish,
one,
becomes a part
yeah.
of your satellite portfolio. Manish, all this becomes a part of your satellite portfolio, not the co-portfolio. Now, if one has to review the co-portfolio, that is your basic bread and butter. That is the investment you might rely upon once you retire for regular income. How can one do it?
Sure, I think that's a very valid question. I feel the review is also extremely important for the core portfolio. At one point of time, IT was supposed to be bellwether. It was supposed to be a defensive part of the portfolio. It was supposed to protect us from a depreciating currency. And 2026 and much of what we saw in 2025 proved us otherwise. So a lot of these assumptions have to be put into perspective when we are reviewing a core portfolio. I'll give you a very simple example. Tax changes that happened in 2023 would have had to made everybody reconsider how are they going to look at their debt allocation, because suddenly debt became extremely tax inefficient, and especially to those folks who were near about or just about to realize their superannuation or retirement, and they were looking at these debt instruments and were looking at double indexation.
All right, Manish, I'm slightly pressed on time, but then let's just move on quickly. I want to understand what to exit in the portfolio in terms of exposure. And if I have to talk about equity, we look at large, mid, and small cap. Now, it also depends how are you placed in the portfolio, whether you have direct equity, which is through stocks, or you are invested in equity via mutual funds. If that is the case, and if we just have to revamp or reallocate or reshuffle our equity aspect in the portfolio, how can one do it?
Sure. I think we should take a top-down approach. The most important thing is to remember that a 60-40 equity debt portfolio that moves to a 75-25 equity debt portfolio is not a better portfolio, it's just a riskier one. So first is we have to establish bands post which a realignment is definitely mandated. Once we've identified those bands, we need to establish, once the breach happens, the corrective action. So the corrective action generally is to move away from equity and realign towards debt, or move away from large cap and realign towards mid caps or small caps, depending upon what has run up and what is expected to run up. I think what most of us forget is the
But this allocation in equity is also aligned with your financial goals. I mean, there was something that you had
absolutely.
in mind and you had invested for. So now, exiting it and putting that chunk in debt, won't that just take you back as far as your financial goals are concerned?
Right. So very valid point, right? So it's a very customized and systematic approach towards each and every goal. So an approach towards a
Okay.
goal which is 3 years away will be completely different to a goal which is 10 years or 15 years away. So as you approach a goal which is 3 years away, your rebalancing will be required, because you cannot afford a drawdown in the market to impact the achievement of the goal. And as and you rightly mentioned, a 10-year goal is not impacted by what's happening in the market in the next 1 or 2 years. The point that I was trying to make is also that when we are looking at rebalancing, some of the aspects that we ignore are taxation, exit or entry clauses. Uh, uh, More importantly, if the portfolio has drifted away towards being equity heavy, you can, instead of exiting a particular fund, you can simply redeploy the additional capital coming into debt, which will realign your equity and debt allocation.
Perfect. Let's talk about commodities and let's talk about gold and silver specifically, which have given a superb return. But then, yes, lately we've seen the performance not being that great. Time to book profits over there?
Yeah. So, we've seen gold running up from 70K to about 160, 65 and coming back to 142, right? To answer your question, I think you answered the question in the previous line. It entirely depends upon your time horizon. Gold should be a part of everybody's portfolio. And clearly, if your allocation towards gold has moved beyond your initial allocation, then you must definitely look at profit booking. Like I mentioned there, Kavita, it's very important to
So,
look at
question over
the
here,
tax
Manish, would be an
implications
ideal
also.
thumb rule. So, the question over here, Manish, would be an ideal thumb rule to invest in commodities or maybe just gold and silver is 10 to 12% of your entire portfolio. Is that right? One should not be going beyond that and no return chasing.
Yeah, absolutely. So this is also, you're absolutely right. So this has also evolved over a period of time. The traditional thought process was a 5% allocation in commodities. This moved to 10%. I think while we take gold and silver in the same breath, but they're two different commodities with completely different risk profiles. We should not confuse the two. I think most viewers who are not as initiated should stick to only gold. Silver, of course, has its own risks associated with it.
Perfect. I just want to understand now if you are parking money in debt, what kind of instruments would you select? I mean, definitely depending on your time horizon and your risk appetite, but there are 16 categories in debt and fixed income. If we have to just look at mutual funds, I mean, if you're talking about outside mutual funds, so are you also considering fixed deposits? They look attractive so far.
Sure. So Kavita, I think debt is a very broad term, but I don't think it has a homogeneous meaning for all of us. Your understanding of debt, my understanding of debt, my mother's understanding of debt could be completely different. It could vary from a AAA bond to a fixed deposit to a government of India only. It is the acceptability for all of us, which varies. To answer your question, I think the first port of call for everybody has been arbitrage funds because of their tax treatment as equity funds. In addition to that, there are a lot of hybrid debt instruments which have come up, like InvITs and REITs and SM REITs, which have gained a lot of traction. One has to be extremely selective while picking these instruments because they are not like your traditional debt instruments, which are purely backed by the credit quality of the issuer, but there are certain equity elements associated with it also. There are, of course, multi-assets fund, which also help us achieve the same tax efficiency and
So I was
are slightly
just
more. Yeah.
exactly. So I was just coming on that because you're talking about REITs and InvITs. We have all this being offered in multi-asset allocation funds, barring the crypto part. Crypto, again, it depends how well you understand crypto and how comfortable you are with that kind of a risk. But having said that, now since we're talking about a multi-asset allocation fund, which is very well diversified, and the fund managers do the balancing depending on the asset class and the movement and the trajectory. We get that. In the entire portfolio, how much will be the placement of that multi-asset allocation fund then?
See, again, it varies from person to person. Clearly, a portfolio which is more prone to take risk would have a lesser allocation, but you can easily go up to 20 to 25% of the portfolio. As you rightly mentioned, the portfolio is extremely diversified, and rather than you or I, while we are engaged in it's my day job, but for a lot of people who are CXOs, CEOs, promoters running businesses, for them to identify when is it a good time to exit gold and enter silver or vice versa is extremely difficult, and that's where multi-asset funds meet that requirement.
The five-step process
So
that
a
you
20 to 25% is a good allocation.
okay,
Yeah,
perfect. So the
sorry.
five-step process that you are talking about over here is review your investment plan, check portfolio alignment, measure portfolio drift. What is portfolio drift? If you could just help us understand.
Sure, of course. Yeah, yeah. So see, I'll take an example of a simple stock. So SK Hynix has grown by 15x over the past 3 years. If you happen to have that in your portfolio would have been skewed in terms of equity and in terms of a particular geography. So portfolio drift is essentially the market is running in one direction. Your portfolio automatically gets skewed towards equity. And if the markets haven't run up or have moved in the other direction, it can get skewed towards debt. So while you are rebalancing your portfolio, you should ensure that you address that portfolio drift as well.
Okay. All right. So after that, all you have to do is just rebalance decide the corrective action and rebalance gradually. One last question before I let you go,
Kavita,
Manish.
if I
I
could,
want, sure. Yeah. Yeah.
sorry, I think the most important step that we follow here at IFL Capital is the formation of an investment policy statement. I think that is something that all clients, all investors in the market should do. It's a charter that an individual, corporate, or family office should follow. It basically enlists and outlines everything right from your goals, your objectives, the benchmarks against which you're going to compare how much of your portfolio should be locked in. It should maintain an asset register so that this is discussed within the family, so that I was reading somewhere that this year is going to be the highest year in terms of unclaimed assets, right? And that clearly shows that at times families do not disclose the entire portfolio to everyone. So investment policy statement is the basis. You compare your portfolio, your investment policy statement to identify if there's a divergence between the two, and you address that divergence through a portfolio rebalancing activity.
All right. I think with that, we are time up on this particular segment. Thank you so much, Manish, for taking your time out and helping our viewers understand every aspect of rebalancing or reshuffling their portfolio and doing the half-year review. Thank you so much. All right, with that, it's time for a short break. But post that, we'll be joined by Aditya Shah, who will be looking at your portfolio queries and giving you the right plan for all your financial goals. So stay tuned. Send across your questions on the WhatsApp number and email ID flashing on the screen.